I'm going to talk about one of the manufacturing company in India. Now I'm going to talk about the bikes and bikers, which is Bajaj Auto. Okay, Bajaj Auto Limited is actually under the organization of the Bajaj Group, and this Bajaj Group is consists of the family members of the Jamnalal Bajaj. Okay, and this Bajaj Auto is actually created by the Jamnalal Bajaj at Rajasthan in 1940s, and this biggest three-wheeler maker is a very reduced cost, and it is located. Their headquarters is actually at R&D, and they already sell 100,000 of the vehicles in 1977, and it was a really good achievement of their company. And okay, as we know that this Bajaj Auto is actually the sixth biggest producer of the bikes and bikers in the world, and the top second of three-wheeler makers in India. And this is a very good achievement of the Bajaj Auto.
Average index score is a measure of changes in a manager gathering of individual information efforts, or at the end of the day a multiple measure that totals various indicators. This average is a measurement to see the level of compliance of this company in 5 years, whether they are using the principle of corporate governance. Based on this line chart, we can see the index score was a bit down when it comes to year 2013 until 2015. On getting a better performance, corporate governance is really important. Whether they implement full codes of corporate governance, which are transparency, fairness, accountability, and independence. Besides, this index score can affect the profit of the company. We can see on figure 4.2 average return on asset was seen on 2013 until 2015, and we can see it was affected by corporate of governance. On 2011 and 2012, the index score was 0.8, followed by 2013 until 2015 was drawn to 0.7. The figure above shows that the average return on asset was shown in 5 years performance of Bajaj Auto Company. As we can see, the performance was good at first 2 years and sank on 2013, 2014 and 2015. This average return on asset is a measurement of how gainful an organization is in respect to its aggregate resources. ROA gives the manager, investors, or shareholder a thought in the matter of how effective an organization's administration is at utilizing its resources for creating income. Then on 2011, the average was on 0.0179%, and 2012 was a little bit down. And we can see the company is efficient in utilizing their assets to generate income. Furthermore, the average on 2011 was the highest value among these 5 years' performance. Liquidity risk is the risk that stems from the absence of attractiveness of an assumption that can't be purchased or sold rapidly enough to predict or limit a loss, which means risk that a company may be powerless to meet short-term financial demands. This usually occurs due to the incapability to change a hard asset to cash without a loss of capital. It is measured that on 2015 was the highest current ratio, 2.1282. They have enough current assets to cover their current liabilities. On 2011, it was the lowest current ratio, 0.7863, which means they don't have enough assets to cover for current liabilities. Starting 2012, the current ratio was getting good in terms of covering current liabilities because the value is getting higher from year to year. Based on table correlation benchmark, the independent variables that has connection with dependent variable can be determined through level of p-value. P-value less than 0.01 indicates that independent variable has the most influence on the dependent variable. Meanwhile, p-value less than 0.10 has the lowest influence. According to the table 4.8, the independent that only has a connection with dependent variable is return on equity and operational margin. Return on equity is negative with t negative 0.42.821. Meanwhile, operational margin was found negative 0.510 and found to be a negative, but has a significant relationship with liquidity risk. It has the least significant influence rather than return on equity. Pearson correlation is to measure the strength between two variables, which is dependent variable and independent variables. Based on table 4.6, the average collection period is 0.836, high positive correlation and significantly correlated to liquidity risk. It shows that liquidity risk increase, the average collection period also increases. If the liquidity risk is high, the chance of assets turning to cash can be in a short period and fast. Meanwhile, the correlation return on asset is very negative correlation, negative 0.969, not significantly correlated to dependent variable. Besides, beta is moderate positive correlation and not significantly correlated to liquidity risk with p-value higher than 0.10. All of these independent variables are not significantly correlated to dependent variable. According to model summary, the adjusted R-square is equal to 96.3%. This shows that by using all internal and macro-independent variables which known as a return on assets, return on equity, average collection period, operational income, operational margin, beta, and debt to income shows that the variables used in the model explains that 96.3% of the variance in the liquidity of Bajaj Auto Company manufacturing based in India. Meanwhile, the remaining 3.7% of the adjusted R-square remain unknown. This tells us that 3.7% of the adjusted R-square is the variance of liquidity risk of the Bajaj Auto that are unable to be explained by both internal and macro variables.
Based on findings and research that I do for Bajaj Auto, I can say that the firm's specific and macroeconomic factors have a link with the dependent variable, which is liquidity risk. Now, I can say that the index score can affect the company performance in terms of the corporate governance. Well, if the one company is not implement a full code of corporate governance, I think that they cannot perform better in terms of profitability and accountability, fairness, and independence. And this corporate governance is really important for the company if they want to achieve a better results or better performance. And it's really good for them to have a very, that the systematics of their system. And I'm sure that this corporate governance can help company outside there to have a better performance.
Hi, Assalamualaikum. Today I will explain about data analysis in hero motor companies. Financial statement analysis allows researchers to identify the trend of the companies by comparing the ratio across 5 years period. There are the three main components of the financial statement: income statement, balance sheets, and cash flow statement. These statements allows researchers to measure liquidity, profitability, leverage, operational, and company-wide efficiency. Pearson correlation is used to determine the relationship between dependent variables and independent variables. The table below is used as benchmark to determine the relationship between the variables. Based on table 4.1, average collection period is strongly positive and significantly correlated to liquidity risk, which is p-value is more than 0.9. It indicates that when the average collection period increases, the liquidity risk also increases. This is because when the firm required longer time to collect back their money from customer, the firm also have to keep more reserve in terms of cash and short-term securities in order to meet their liquidity requirement. This will reduce liquidity problem when creditor claim their money back. Meanwhile, beta is moderate positive but not significantly correlated to liquidity risk, which p-value is 0.1. All of these independent variables have no relationship between the dependent variables. Coefficient. Based on the use of coefficient, the independent variables that has influence on the liquidity risk can be determined through the identification of significant level of 2%, which p-value. P-value is less than 0.001 indicate the independent variable has the most influence on the dependent variables. P-value less than 0.05 indicate a moderate influencer of independent variable on the dependent variable, while the variable that has p-value 0.1 has the least influence. Besides that, beta was found to be negative and has the least significant influence on the liquidity risk, which p-value less than 0.1. T is negative 7.854. Since beta is used to calculate the market risk, it means that when the risk of the market decreases, it will also influence the liquidity risk, but with a minimal effect. According to table 4.4 above, the adjusted R square is equal to 93.8%. It implies that by using all the internal and macro variables in equation 3, model 3, which known as a return of equity, average collection period, operational ratio, index score, inflation, and beta, show that the variable is used in the model able to explain 93.8% of the variance in the liquidity of manufacturing sector for Hiromoto Corporation, while the remaining of 6.2% of the adjusted R square remain unknown. This implies that the remaining of 6.2% of the adjusted R square show that the variance in the liquidity risk of the company in the manufacturing sector are unable to explain by the both of the internal and macro variable for the equation 3, table 4.4. This gives an opportunity to researcher to conduct a future research regarding the unknown factor. Besides that, the ANOVA table above show that a significant value of 0.04, which is below the alpha value, P is less than 0.05. It indicates that the variable is perfectly significant to represent the model. Thus, the significant value above is an acceptable value that indicate the model of the study are acceptable and reliable. As conclusion, based on the table of both correlation and coefficient, there are evidence showing that liquidity risk has been influenced and affected by firm-specific factors in terms of average collection period and corporate governance element. The correlation table showed that ACP is strongly positive and significantly correlated to liquidity risk, which p-value is 0.9.
Is Noraina Farahin, Binti Muhammad Kodori. On my presentation, I would like to focus on the Hindustan Unilever Limited company that based in India, and the raw data is collected from year 2012 until 2016 annual report. So after doing the analysis, we can conclude that on the Pearson analysis, beta has the highest positive correlation with the liquidity risk with the value of 99%, and remunerations are stated that with the value of 82.6% in a positive relation with the liquidity risk. Next, the average collection period state that 95.8% the positive relationship. The leverage score is 34%, and the negative for the negative relationship with the liquidity risk, we have ROA with the value of 66.8, the ROE with 49.5, and the index score 85.2%. Those are the factory specific factors that affects on the liquidity risk as whole. So for the macroeconomic factor, we have the GDP with a negative relation, which is 78.9%, and the other three factors, which are unemployment rate with the 82.9%, and exchange rate with 83%, and the inflation rate with 63.8%. On the model summary and the ANOVA analysis, we can conclude that only the factory specific factor that have effect on the liquidity risk. Summary has the value of R square with the 98%. I want to conclude that in order to have a lower liquidity risk, the company must have an efficient management on their credit, on their collection period management. A great average collection period demonstrate that the company have the good and great management in receivable account. On top of that, the great average collection period leads to a higher liquidity risk of the company. I would like to recommend that this company must have a credit policies, as their company can detect the meanness of their customer to pay their debt. In addition, the company can have a check and track for their customer that have a bad history on paying their debt on their previous transaction. This company must fulfill the corporate governance principle onto their company such as transparency, accountability, fairness, and independence. For the fairness aspect, the companies the company company can manage to control the cash amount on their remuneration or salary of the board of director in order to overcome the problem of liquidity risk that faced by the company. The factors the factory specific factor is the most impact on the liquidity risk compared to the macroeconomic factor. That's all from me. Thank you.